MicroStrategy is one of the boldest financial experiments ever attempted. A publicly traded software company that transformed itself into the world's first corporate Bitcoin vault. A company that abandoned traditional growth strategies and instead bet everything on digital gold. And behind this bet stands one man, Michael Saylor, a leader who made a decision so extreme, so absolute, that it shocked Wall Street and divided the entire financial world. His approach was simple. If Bitcoin is the superior asset, then buy it. Hold it. Borrow to buy more of it. And hold that too. For years, this strategy worked beautifully. MicroStrategy's stock surged. Bitcoin climbed. Saylor became the face of the Bitcoin revolution. But today, something has changed. Not because Bitcoin is broken. Not because the thesis is wrong. But because MicroStrategy's structure, the architecture of the entire strategy, has a built-in weakness. A weakness almost nobody is talking about. So buckle up, because later in this video, I'll tell you exactly what move could save MicroStrategy and Michael Saylor from a silent problem that grows larger every day. But first, we need to understand how Saylor engineered the system, why it worked, and why it may not work anymore. MicroStrategy used to be an ordinary analytics company. It made software, it generated modest revenue, and it sat on cash reserves until Saylor decided cash was a melting ice cube. So he did something no CEO had ever done before. He put the company's cash into Bitcoin. Then he issued corporate debt to buy more Bitcoin. Then he issued convertible notes to buy even more Bitcoin. It didn't take long for MicroStrategy to transform. The company stopped behaving like a software firm and started behaving like a Bitcoin ETF with a cash flow engine attached. It was brilliant during the bull market. Bitcoin rose. MicroStrategy rose even faster. The debt became easier to manage. The balance sheet ballooned. Investors treated MicroStrategy stock as a leveraged Bitcoin play. But the entire strategy has one critical flaw. MicroStrategy earns zero yield on its Bitcoin. The company now holds over 600,000 Bitcoin, a digital treasury that rivals nation-states. But unlike every major institution holding assets, MicroStrategy earns no income from its position. The entire corporate engine depends on Bitcoin going up. Only up and only fast enough. If Bitcoin stays flat, MicroStrategy generates nothing. If Bitcoin drops, pressure builds. If Bitcoin enters a long sideways winter, dilution, debt restructuring, or forced selling becomes a risk. This is the structural vulnerability. MicroStrategy doesn't just need Bitcoin to grow. It needs Bitcoin to work, to produce yield, to generate income. And for the first time since MicroStrategy began its grand experiment, a technology has emerged that could provide exactly that. A way to earn Bitcoin yield without moving Bitcoin, without wrapping Bitcoin, without bridging it, and without breaking Saylor's never sell principle. That technology is called Babylon. Bitcoin is the most secure monetary network ever created, but it has no native yield. No staking, no delegation model, no interest. Bitcoin doesn't work. Bitcoin waits. Babylon changes that. Babylon allows Bitcoin holders to stake BTC safely while keeping the actual Bitcoin on the Bitcoin blockchain. No wrapped assets, no third-party custody, no bridges, no smart contract risk. Your Bitcoin stays in cold storage, untouched, exactly where Saylor believes it belongs. Yet it becomes productive. Babylon allows Bitcoin to secure external proof-of-stake networks through cryptographic proofs. This means Bitcoin holders can earn staking rewards without ever leaving Bitcoin's security model. Now here's where everything changes for MicroStrategy. If MicroStrategy truly holds more than 600,000 BTC, Babylon unlocks an entirely new financial reality. But to stay accurate and credible, let's be clear. Babylon does not promise specific yields. It does not advertise high returns. Its entire philosophy is secure, low-risk Bitcoin yield based on real validator economics. So let's simplify what analysts realistically expect. A very conservative estimate is about 1% per year. A standard conservative range is around 2%. A moderate real-world scenario is closer to 3%. And in more optimistic, but still reasonable cases, rewards could reach 4 to 5% annually. Now let's translate that into what it means for MicroStrategy. At 1%, MicroStrategy would earn roughly 6,000 Bitcoin per year. At 2%, that becomes about 12,000 Bitcoin per year. At 3%, it climbs to roughly 18,000 Bitcoin per year. And at 4 to 5%, MicroStrategy could be looking at 24,000 to 30,000 Bitcoin every single year, in yield alone. Even the lowest scenario provides real income. The middle range creates financial breathing room, and the upper range could transform MicroStrategy from a passive Bitcoin vault into the world's first Bitcoin-powered income engine. And all of this happens without selling a single Satoshi, without moving Bitcoin, without compromising custody, without breaking Saylor's core principle, never sell your Bitcoin. MicroStrategy needs yield. That is the evolution, the missing piece. The next step. If MicroStrategy activates Babylon, it won't just hold Bitcoin, it will activate Bitcoin. It will turn its treasury into a productive machine. It will become a Bitcoin superstructure unlike anything the world has seen. The question now is simple. Will MicroStrategy remain a passive Bitcoin vault or become the most powerful Bitcoin income engine on Earth? This story is only beginning.